Imagine the stock market as a vast ocean. Sometimes the surface is calm and prices rise steadily. Other times, storms hit and prices plummet. This is where savvy investors can find opportunities. Two popular strategies are bottom fishing and buying the dip. Both involve purchasing stocks when their prices have fallen, but they differ greatly in approach and risk. Bottom fishing is like searching for treasure on the ocean floor. It involves buying stocks that have dropped significantly in price, hoping they'll bounce back. Buying the dip is more like riding a wave. It means purchasing stocks during a temporary downturn, expecting the overall upward trend to continue. Understanding the differences between these strategies is crucial for any investor. It can mean the difference between reeling in a big catch or getting caught in a rip current. Bottom fishing is a high-risk, high-reward strategy. It involves buying stocks that have experienced a dramatic price drop. The hope is to buy low and sell high when the stock rebounds. However, timing is everything, and this is where many investors get caught. Imagine a company facing serious problems like declining sales or legal issues. Its stock price plummets. A bottom fisher might see this as a bargain, believing the stock is oversold. But what if the company's problems worsen? The stock could continue to fall, leaving the investor with a significant loss. Bottom fishing requires careful research and analysis. Investors need to determine if a stock's decline is due to temporary factors or deeper fundamental issues. It's like checking the weather forecast before going fishing. A sunny day might mean calm waters, while a storm could spell disaster. Buying the dip is a more common and generally less risky strategy than bottom fishing. It involves purchasing stocks during a temporary market downturn. The key is to identify stocks that are fundamentally sound but have been caught in a broader market sell-off. Think of a surfer waiting for the perfect wave. They don't jump in during a tsunami. Instead, they wait for a temporary dip in the water, knowing a powerful wave will follow. Similarly, investors buying the dip are looking for short-term price drops in companies with long-term growth potential. This strategy requires strong market judgment and an understanding of economic cycles. Investors need to distinguish between a temporary dip and a more serious market correction. It's like knowing the difference between a passing shower and a full-blown hurricane. Section 4. Comparing the strategies nets versus surfboards. While both bottom fishing and buying the dip involve purchasing stocks at lower prices, their approaches differ significantly. Bottom fishing is like casting a wide net, hoping to catch anything. Buying the dip is more selective, like a surfer choosing the perfect wave to ride. Bottom fishing carries higher risks. Investors are often enticed by significantly discounted prices, overlooking the underlying reasons for the decline. It can lead to catching falling knives, where stocks continue to plummet. Buying the dip, while still involving risk, is generally considered a more calculated approach. Investors focus on fundamentally strong companies experiencing temporary setbacks. This strategy requires patience, market knowledge, and the ability to identify buying opportunities amidst market volatility. Choosing the right strategy depends on an investor's risk tolerance, investment goals, and market expertise. It's like choosing between fishing in a calm lake or surfing in the open ocean. Both can yield rewards, but the risks and skills required differ significantly. Section 5. Conclusion: navigating the market waters. Navigating the stock market requires knowledge, strategy, and a bit of luck. Bottom fishing and buying the dip are two strategies investors use to capitalize on market fluctuations. Understanding the risks and opportunities associated with each is crucial for success. Bottom fishing, like deep-sea exploration, can yield treasure but also carries significant risks. Buying the dip, like riding a wave, requires timing and market judgment. Both strategies demand careful research, analysis, and an understanding of market dynamics. Before diving into either strategy, it's essential to assess your risk tolerance, investment goals, and market knowledge. Remember, the stock market is a vast and ever-changing ocean. Understanding the currents and choosing the right vessel is paramount to navigating its waters successfully.